They told you that success in trading was about being right. They said the best traders had 90% win rates, laser-like accuracy, and unshakable confidence. They said if you could just find the perfect strategy, you'd finally beat the market. But that's a lie, a beautiful, expensive lie. The truth? You can be wrong 8 times out of 10 and still walk away rich if you know how to lose small and win big. Imagine that, losing most of the time, yet becoming consistently profitable. That's the paradox that every great trader eventually learns. Trading is not about how often you're right, it's about how much you make when you are. I remember sitting in a chaotic trading room during the 2008 crash, phones screaming, screens bleeding red, and a man next to me whispering, "It'll come back." It didn't. He blew up his account in less than a day. Not because he didn't understand the charts, but because he refused to understand himself. Markets don't kill traders. Ego does. For 2 decades, I've seen it all: the dot-com bubble, the crypto mania, the COVID meltdown, and through every financial earthquake, one rule never changed. The market rewards the disciplined, not the desperate. The disciplined cut losses like surgeons. The desperate chase redemption like gamblers. So here's your wake-up call. Forget chasing perfection. Forget your obsession with being right. The secret lies in mastering asymmetry, that strange but beautiful math where a few big wins erase dozens of small losses. That's how Jim Simons, the math wizard behind Renaissance Technologies, crushed the markets with a mere 55% win rate. That's how Soros and Druckenmiller built empires. And that's how you'll finally stop bleeding from your own illusions. Welcome to Trading Psychology Stick, where we talk about what really moves markets, the mind behind the mouse. Before we go further, quick disclaimer: nothing here is financial advice. I'm sharing 2 decades of experience, both wins and scars, but your trading decisions are yours alone. Do your own research, manage your own risk. Now, we have to destroy the first illusion that traps every beginner: the belief that a high win rate equals success. Section 1. Win rate doesn't make you rich. Payoff does. You can win almost every trade and still go broke. Let that sentence sink in, because deep down, every trader secretly chases the same drug, the dopamine rush of being right. We crave confirmation, not profit. But the market doesn't pay for accuracy. It pays for asymmetry, the art of making far more when you're right than you lose when you're wrong. Picture this: 2 traders, same system, same charts, same instruments. Trader A wins 7 out of 10 times, but every loss is 5 times larger than each win. Trader B wins only 3 out of 10 times, but every winner pays 4 times what he risks. Guess who survives? The one who understands expectancy, the real currency of this game. Expectancy isn't magic, it's math. It's the formula that separates dreamers from operators. Expectancy equals win percentage times average win minus loss percentage times average loss. Simple, brutal, liberating. Early in my career, I was obsessed with precision. Every trade had to be perfect. The clean entry, the flawless setup, the textbook confirmation. I had weeks of perfect streaks, yet my balance barely grew. Then one Friday, one oversized position wiped out all my gains. I remember staring at the screen, paralyzed, realizing that my entire strategy was built not on logic, but on ego. I was trading to feel smart, not to make money. That night, a mentor said something that hit like a thunderclap. If you're obsessed with winning, the market will humble you. But if you're obsessed with expectancy, the market will feed you. From that day, I stopped counting how many trades I won. I started tracking how much I made when I was right, and how little I lost when I was wrong. This is where everything changes, the shift from ego metrics to operator metrics. Ego asks, how often am I right? The operator asks, what's my average reward per risked dollar? The ego wants to prove something. The operator just wants to extract value. So ask yourself this: do you trade to be right, or do you trade to grow? If your entries feel good but your equity curve doesn't, it's time to change what you measure. Forget win rate, it's a vanity metric. Track your reward to risk ratio, your expectancy per trade, and your maximum drawdown. Those numbers tell the truth your emotions hide. The real shift happens when you stop trying to win every trade and start becoming consistently profitable. When you detach your self-worth from your win rate, you trade lighter, cleaner, freer. You stop forcing setups. You start thinking in probabilities. You finally understand what Buffett meant when he said, rule number 1, never lose money. Rule number 2, never forget rule number 1. That's not about never taking losses. It's about never taking uncontrolled ones. It's about designing a system where your few big wins erase a field of tiny cuts. The market is chaos, but in that chaos lies an equation, a predictable imbalance between fear, greed, and math. And once you learn to operate on the side of math, the chaos becomes opportunity. You're starting to see it now, aren't you? The game isn't what they told you it was, but understanding asymmetry is just the beginning. Because if only 20% of your trades create 80% of your profits, then the real question becomes, how do you find those 20%? The answer lies in a map. Section 2, the 20/80 map of profits, how to hunt the few that feed the many. The cruel irony of trading is that most of your effort won't matter. 8 out of 10 trades you take will do little more than churn your emotions, nibble at your account, and teach you patience. But nobody wants to face this. Your entire year's profits will likely come from a handful of extraordinary trades, the rare 20% that do 80% of the heavy lifting. Professional poker players don't play every hand. They fold, 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 then strike when the table tilts in their favor. The same applies here. You don't need to be in the market all the time. You need to be in the market when probability and psychology align. Those rare intersections are what I call consensus zones, points where technicals, crowd behavior, and institutional intent collide. I first saw this during the chaotic months after the 2008 crisis. Everything was collapsing, banks, indexes, even currencies. But amid the noise, there was one level on the S&P that had been tested 4 times and held. Every hedge fund on the street was watching it. The tension was electric. One day, the market flushed below it, a brutal false break, and then rocketed back above with monstrous volume. That single setup, executed with precision and a tight stop, covered months of prior frustration. That was my 20%. The rest of the year, a sea of sideways grind and tiny scratches. That's when the pattern became clear. Trading isn't about constant motion. It's about strategic stillness. You prepare 80% of the time, so you can act decisively the 20% of the time it counts. What most traders overlook, those high-value trades don't scream at you. They whisper. They appear where confluence builds. Structure meets moving averages, meets liquidity pools, meets sentiment fatigue. When enough forces compress into one zone, pressure builds until one side snaps. And when it snaps, price doesn't drift, it erupts. That eruption is where asymmetric payoff lives. You're not aiming for constant accuracy. You're waiting for the moments where risk is tiny and potential reward is massive. Maybe it's a long-term support that's been defended for months, or a breakout from a multi-week range where the crowd is trapped on the wrong side. The amateur sees random levels. The professional sees consensus breaking down. To harness this, you must create your own 20/80 map. Go through your past 100 trades. Identify which setups, conditions, or times of day produce the majority of your profit. You'll find a pattern. Maybe most of your winners came during London session reversals, or after daily liquidity sweeps, or on specific assets like gold or NASDAQ. That's your fertile ground. Everything else, wasteland. Once you have this map, guard it like a secret weapon. Trade only when the environment matches those golden setups. Skip the rest. Remember, opportunity cost is invisible, but lethal. Every mediocre trade you take drains the focus, capital, and emotional bandwidth you'll need when the real one arrives. Professionals don't chase trades. They design conditions for the top 20% to appear. They let the market come to them. That's not laziness, it's strategy. Patience, disguised as boredom, becomes your weapon. Your homework matters. Pull up your trading journal. If you don't have one yet, that's fine. We'll build one later. But if you do, scan your last 50 trades. Which 3 produce the most profit? Write down the exact conditions: time of day, asset, setup type, market environment. Then ask yourself, when was the last time you deliberately waited for those exact conditions before entering? Drop your answer in the comments. Be specific, because specificity is where Edge lives. Once you internalize this, the game changes. You stop being the hunter running through the forest. You become the sniper on the hill, calm, still, deadly precise. And when that moment comes, when the chart hits your consensus zone, when volume and sentiment align, you don't hesitate. You pull the trigger with clarity, knowing that even if you lose, it's just one bullet among many. But if you win, it's the trade that feeds the rest of the year. But most traders stumble right here. They find the perfect setup, they see the consensus zone forming, and then they jump in too early. The direction is right, but the timing kills them. Because catching the 20% means nothing if you can't stay in long enough to let them bloom. Precision isn't about guessing, it's about patience under pressure. Section 3. Entries that age. Well, the art of patient precision. Most traders lose not because they misread the market, but because they enter too soon. They see a candle move, their heart races, and before logic can intervene, their finger clicks buy. What they call intuition is just adrenaline wearing a disguise. Timing isn't about guessing direction. It's about letting the market confirm what you already suspect. Picture this. NASDAQ flashes a clean breakout. Chat rooms explode. You jump in, terrified of missing it. Minutes later, you're stopped out. Then it resumes without you. Sound familiar? You didn't lose because the direction was wrong. You lost because your entry wasn't aged enough to survive volatility. You picked a fruit still green on the branch. Entries that age will come from the discipline of waiting for the retest, waiting for the sweep, waiting for the market to show its hand. The pros know that price doesn't move randomly. It hunts liquidity first, then trends second. They wait for that sweep, the moment when the crowd gets faked out, when weak hands buy the high or sell the low, and only then do they strike. It's not about entering early, it's about entering last and right. I once mentored a trader named Leo, brilliant with analysis, hopeless with patience. He'd spot beautiful levels, mark them perfectly, then jump before confirmation. His reasoning? I don't want to miss it. Over time, his chart looked like a graveyard of almost great trades. One day, I challenged him. Pretend your mouse is broken for the next hour. You can analyze, but you can't enter. Reluctantly, he waited. When the setup finally retested his zone and showed a rejection wick with rising volume, he entered late, or so he thought. That trade became his biggest winner of the quarter. The irony? Doing nothing made him profitable. To make entries that age well, you need a rule. No trigger, no trade. The trigger is your signal of intent, a break and retest, a liquidity sweep and reclaim, an inside bar breakout with momentum. You define it before you enter, never after. The beauty of this discipline is that it reduces heat, the pain of watching price move against you after entry. Lower heat equals longer hold, and longer hold equals bigger payoff. That's how expectancy compounds silently in your favor. What most don't realize, when you enter too early, you don't just lose money, you lose psychological capital. You start doubting your plan, you cut winners short, you tinker with stops. A premature entry corrupts every decision that follows. But when you wait for the perfect moment, that alignment of structure, volume, and psychology, your mind is calm. You know exactly where you're wrong, and you're willing to be wrong quickly. That's what allows your right trades to breathe. In the end, an entry is like a first impression. It sets the tone for the entire relationship between you and the market. A sloppy entry makes for a toxic partnership, full of drama, stress, and second-guessing. A clean entry, defined, deliberate, delayed until confirmation, gives you peace of mind and room to let profits grow. So next time your hand itches to click early, remember this. Impatience is the tax you pay for mediocrity. Every tick you wait is a test of your conviction, a filtration process separating emotion from edge. The longer your entry can age before it triggers, the stronger its DNA. Because every trade has a heartbeat, the rhythm between chaos and clarity. Listen long enough for that rhythm to align with yours. Only then do you strike. And when you do, you'll realize what it means to enter not with hope, but with precision. You've learned how to find the 20%, how to wait for them, how to enter with patience. But no matter how perfect your entry is, it's your exit that decides whether you walk away with gains or regrets. And that's where most fortunes are lost. Section 4. Exit and trailing mastery. The art of letting winners run. Entries get all the glory. They're the highlight reels traders post on social media. The perfect arrow at the perfect candle. The snapshot frozen at the moment of genius. But exits? That's where the real battle begins. Because the second you're in a trade, your mind splits in two. One side wants to protect what you've gained, the other wants to squeeze every drop of profit from it. And between those two voices lies the thin line between mastery and madness. And at NVIDIA 2023, I caught the breakout, Watched it surge 20% in a day. Fear whispered, "Lock it in." I did. The next week, the stock ran another 60% without me. I didn't lose money, I lost opportunity. And opportunity, once gone, doesn't send a refund. That's when I made a vow. Never again would I cut a winner without a structural reason. No more panic exits, no more impulse clicks. Instead, I'd let the market tell me when the trend is over. Few traders know how to stay in a trade. The real money isn't made at entry, it's made in the quiet discipline of holding, in those long, nerve-wracking hours when you're tempted to take your profit and run. Because every trend, no matter how strong, will test your patience before it rewards it. The market whispers, "Take it now," before it vanishes. And that whisper has killed more 10R trades than bad entries ever will. The reality is this: trailing stops are not about greed, they're about intelligence. They're the bridge between control and chaos. A well-placed trailing stop lets your trade breathe while protecting its life. It's the balance between fear and freedom. You don't use a fixed pip count because markets are living systems, not machines. You trail beneath structure, under higher lows in an uptrend, above lower highs in a downtrend. When the structure breaks, that's not just a price shift, it's a psychological shift. It means the crowd's narrative has changed. That's your cue to step out gracefully, with profit in hand and dignity intact. One of my students, Daniel, once messaged me in frustration. I always take profit too early, so I gave him a rule. Every time your trade is up 2R, move your stop to break even, then trail by structure. If price forms a new higher low, adjust. If not, wait. Do nothing. He followed it religiously. 2 months later, he sent me his journal. One single trade had run 9R, enough to cover every small loss for weeks. His message read, "The hardest part wasn't holding the trade, it was holding myself." That's the essence of trailing. It's not mechanical, it's spiritual. It's a conversation between you and chaos, where patience speaks louder than fear. A great exit plan neutralizes emotion before it even arises. It's not about prediction, it's about structure. You plan your exits like an architect designs a bridge, every pillar measured, every load tested. You use structure-based trailing stops, move them under the most recent swing low or above the swing high, because that's where the market itself declares the trend invalid. You scale out gradually, 1/3 at 1R, another third at 2R, the rest trailing. You use time stops for trades that stagnate too long, freeing capital for better opportunities. And above all, you remember this law: the first exit plan you write is the only one you can trust. Once the trade is live, your mind becomes a courtroom of excuses. You'll find reasons to break every rule you made in calm weather the moment the storm hits. That's why professionals automate or predefine every rule, to save themselves from themselves. The paradox of profits. They grow in silence, but they die in noise. Every time you stare at your open profit and loss, you feed the noise. Every time you move your stop out of fear, you feed the noise. But when you follow structure, when you trust your system, the noise fades, and you enter the rhythm of the market. That's when compounding begins, not in your balance, but in your behavior. So next time you're tempted to close early, ask yourself, is this exit logical or emotional? Because emotional exits are how the market takes back what it just gave you. The greatest traders don't predict how far price will go. They simply stay long enough to find out. Let your profits breathe. Trail with reason, not emotion. Set your targets based on structure, not ego. Don't aim to sell the top, sell when the story ends. And the market always tells you when the story is over, you just have to listen. You've mastered patience in entries. You've learned to let winners run. But there's one invisible force that controls whether you can even execute these plans. It's not strategy, it's not analysis, it's the weight of your position, the silent puppeteer pulling every emotional string you have. And that takes us to the most underestimated variable in trading. Section 5. Position sizing, the invisible hand that controls your mind. You think you have a strategy problem. You don't. You have a size problem. Position sizing is the invisible hand that shapes every emotion you feel in the market. Fear, greed, hesitation, euphoria. You think it's psychology, but it's physics. The weight of your position determines the gravity of your emotions. Size too large, and every tick feels like a heart attack. Size too small, and you sabotage yourself with boredom and overtrading. The first time I traded size that was too big for my nervous system, it was a volatile morning. EUR/USD spiked on unexpected news, and I saw what looked like the perfect setup. I doubled my usual position, confident it would break higher. It didn't. Within seconds, red numbers bled faster than my logic could keep up. My palms were slick, my heart rate surged, and my breath shortened. I wasn't analyzing anymore, I was hoping. The trade that should have been a controlled risk turned into a desperate prayer. Within seconds, the truth became clear. Size is the real throttle of discipline. Professionals don't size based on confidence. They size based on risk per trade, 1% or less. That's the foundation. Because they know that survival is the only way to stay long enough to win. If you risk 2% per trade, it takes 35 consecutive losses to blow up. Risk 10%, and 10 bad trades end your career. The math isn't negotiable. Size is your emotional thermostat. The bigger the risk, the hotter your emotions burn. The smaller the risk, the cooler your mind stays. You can't make rational decisions when your body is in fight or flight. Adrenaline is great for running from lions, but terrible for executing trade plans. That's why pros design their risk, so that even if they lose 3 times in a row, they're annoyed, not terrified. Their system can absorb the blow without shaking their belief. I once coached a trader named Anya who had a brilliant strategy but constant inconsistency. One month she made 20%. The next, she lost 25%. When we looked closer, the problem was clear. She was varying her position size based on emotion. Bigger after wins, smaller after losses, the classic gambler's fallacy disguised as intuition. So we created a strict rule, same percentage risk every trade, no exceptions. Within 3 months, her equity curve smoothed out like calm water. The swings were smaller, but the growth was sustainable. What separates a professional from a hopeful amateur? Professionals scale with data, not dopamine. They add size only when their edge is proven over a series of trades, not after one lucky streak. And when they do scale, they use house money, the profits from open or past winning positions, never fresh capital. That way, every additional unit of risk is paid for by the market, not by their ego. The paradox: smaller size gives you more control, but more control gives you bigger profits. Because when your emotions stop hijacking your decisions, your edge finally has room to work. Calm minds compound capital. Nervous hands destroy it. So, before your next trade, don't ask, is this setup perfect? Ask, is this size survivable? If your position makes your heart race, it's too big. If you can't sleep with it open, it's too heavy. You don't need to feel nothing. You need to feel in control. Your brain can only process logic when your body isn't screaming. Every trade should feel like brushing your teeth. Important, habitual, unemotional. The second you feel adrenaline, step back. You're not a trader anymore. You're a gambler in disguise. Professionals are immune not because they're fearless, but because they've engineered fear out of their system through consistent sizing. And once your size is under control, you can finally focus on what truly matters, where the crowd breaks. Because trading is not just math, it's human behavior painted on a chart. And understanding where collective emotion turns into opportunity is the next level of mastery, where the herd goes to die. Section 6, the consensus zone, where human belief breaks and money moves. Every chart tells a story, but only a few moments on that chart decide everything. Those are the consensus zones, where the crowd agrees too strongly, where conviction piles up like dry wood, waiting for a spark. To the untrained eye, they look like ordinary support and resistance levels. To professionals, they're psychological war zones. Because when the crowd's belief finally fractures, price doesn't just move, it explodes. Belief in the market is like pressure in a volcano. The more absolute it becomes, the more devastating the eruption when it fails. I remember watching a scene like that unfold. A stock had formed a perfect horizontal support, tested over months. Then one morning, during pre-market, it sliced below that level for 5 minutes, a heart-stopping flush that triggered stop losses across the globe. Within an hour, it was back above, surging with ferocity. That single fake breakdown, a liquidity sweep, marked the beginning of a 30% rally. Everyone who panicked fed those who waited. That was the consensus breaking point, the moment where psychology, liquidity, and structure converged. The consensus zone isn't just a price area, it's a mirror of mass emotion. Buyers think they're safe. Sellers think they're doomed. Both are trapped by their own certainty. The professional trader watches quietly, knowing that certainty is the market's most profitable illusion. You don't predict which side will win, you wait for the break of belief. You wait for that precise second when fear and greed change seats. The critical factor is this: you must define your battlefields before the fight begins. Mark your zones where human behavior is most likely to turn. Multi-tested levels, confluence of moving averages, Fibonacci overlaps, prior liquidity highs and lows. Then, when price reaches that zone, you do nothing until it reacts. You don't guess, you listen. If price breaks through violently but fails to hold, that's your moment. That's where the professionals move in. You enter not on hope, but on evidence of exhaustion. And just as important, your stop must live outside the zone, not inside your comfort. Amateurs put stops where it feels safe. Professionals put them where the thesis dies. If your idea is invalid at 199, your stop belongs at 198. The line must be logical, not emotional. Every pip closer to your stop is a test of your courage to stay rational. A friend once said, "Every price level is a psychological battleground. You just have to wait until the losing side starts retreating." That's what consensus zones are, points of maximum conviction and maximum vulnerability. The herd fights hardest right before it breaks. But this isn't just about finding the zone. It's about understanding what happens after. Because once you've caught the break, once price moves your way, your next challenge begins. Managing the position like a craftsman, not a gambler. Scaling in without increasing risk. Locking profits without choking them. Riding the trend without losing your nerve. And that's the art every professional masters, knowing when they've earned the right to press their advantage. Section 7. Scaling in, playing with the house's money. There's a moment in every great trade when you realize you've earned the right to be aggressive. You're already in profit. The trend is clear. Momentum is building. Most traders tighten up here, terrified of giving anything back. But professionals, they smile. Because this is when they press. Not recklessly, not emotionally, but mathematically. They scale in, not with new capital, but with the market's capital. They're no longer gambling with their own money. They're playing with the house's chips. It's the most misunderstood concept in trading psychology. Scaling in is not doubling down. It's compounding success inside controlled risk. When you're right, you earn the right to add. When you're wrong, you lose small. That's asymmetry in motion, risk fixed, reward fluid. I learned this from a senior trader at a fund in Manhattan. He was calm, quiet, terrifyingly consistent. While others shouted over screens, he barely spoke. One morning, during a trending USD JPY move, I noticed he added to his position twice. I asked, "Aren't you afraid of losing what you've made?" He smiled and said, "I'm not adding risk, I'm adding edge." He explained that each add-on was financed by floating profit. If price reversed to his original stop, he'd lose nothing. But if the trend continued, his gains would multiply exponentially. That's how professionals think. Defense first, offense only when protected. In practice, it looks like this. Let's say you risk 1% per trade and you're up 3% on an open position. You move your stop to break even, securing the initial risk. Now you can reallocate a fraction of that unrealized profit, say half, as new risk for an add-on position. If the market continues, your exposure grows while your original risk remains zero. If it reverses, you walk away flat or with a small gain. The beauty of this method isn't just mathematical, it's psychological. Once your original position is safe, fear dissolves. You stop trading from defense and start trading from flow. Each new add-on is powered by clarity, not anxiety. It's a mindset shift, from trying not to lose to managing how much you win. But let's be clear, scaling in is not for every moment. It's not an ego flex. It's a privilege earned through discipline. You only add when structure supports the trend, when volume confirms continuation, when your system says the move still has fuel. If you add impulsively, you're not scaling, you're stacking grenades. Scaling done right is the opposite of greed. It's patience rewarded. It's confidence expressed as control. You don't add because you're euphoric. You add because the data says the story isn't over yet. You're expanding your position the way an architect adds a new floor to a building whose foundation has already proven solid. Remember this mantra: add to conviction, not emotion. Every time you scale in, ask, has the market validated my bias again? Is structure still intact? Are stops still safe? If not, you stop adding. If yes, you ride the wave higher, knowing you've transformed a good trade into a great one. And when your position grows into something truly significant, when your unrealized profit hums like a living thing on the screen, that's when you'll realize something profound. You're no longer reacting to the market, you're operating within it. You've stopped being a trader and started becoming something more refined. But to sustain that level of performance, you need to understand yourself as deeply as you understand price action. Because your biology, your rhythm, your energy cycles, they're just as important as any indicator on your screen. And that's where self-knowledge becomes your edge. Section 8. Trading DNA and the Operator's Journal. Every trader wants an edge, but few realize that the most powerful edge isn't hidden in indicators or strategies. It's hidden in your biology, your rhythm, your focus cycles, your emotional recovery curve. The market has patterns, yes, but so do you. And until you learn yours, you'll always be fighting a ghost version of yourself. Aaron was brilliant at analysis, but his performance was chaos. 5-figure weeks followed by total losses. After tracking his trades, we found 80% of his losses happened during one-time window. He was trading when exhausted. Once he aligned his schedule with his natural energy rhythm, his equity curve transformed. Same strategy, same market, now synced with biology. You have it too, a unique fingerprint of performance patterns. Maybe you think you trade best at night, but your stats might prove otherwise. Maybe you think you're good with gold, but your data says you bleed on it and thrive with indices. The problem isn't that you lack skill, it's that you haven't mapped your own operating system. Professionals know this. They treat themselves like assets to be optimized. But to build your trading DNA, you need a tool, not just any journal, a real one. The weakest trader forgets, the strongest one documents. Your journal is not a diary, it's a laboratory. It's where emotion becomes information, and information becomes profit. Without it, every lesson you learn fades into noise. With it, every mistake becomes fuel for precision. You can't improve what you refuse to measure. Most people journal wrong. They write vague feelings, good trade today, or I need to be more patient. That's not data, that's therapy. What professionals record is evidence. A real trading journal reads like an engineer's flight log. Setup, entry reason, invalidation point, market condition, emotional state 0 to 5, rule broken yes or no, and planned versus actual reward to risk ratio. It's cold, structured, brutal honesty, and it's what builds mastery. When I began journaling this way, I hated it. It exposed me. It showed how often I moved my stop just this once, how many trades I entered from boredom, how many times I cut profits early while pretending to lock gains. But that exposure was freedom. I couldn't hide behind excuses anymore. And the more I logged, the more I realized that my biggest losses didn't come from bad setups. They came from emotional sabotage. I had one entry that still haunts me: move stop 0.5, R lower to give trade room, result -4R. In OneNote, I had written the blueprint of every future failure. From that day, I swore never to change my plan mid-trade, and the data backed it up. Once I stopped interfering, my expectancy doubled within a month. The journal does something even more profound than track numbers. It tracks behavioral patterns. You start seeing the fingerprints of your own psychology on every chart. You notice that after 2 wins, you tend to overtrade. After 3 losses, you hesitate on the next valid setup. You notice which emotions cost the most and which conditions amplify them. That's how a trader evolves, from intuition to insight, from chaos to control. This is the power of quantifying behavior. The journal becomes your mirror. It doesn't care how confident you sound or how smart your analysis looks. It tells the raw truth. And the truth, though uncomfortable, is always profitable. A simple rule: if you can't explain a trade in 1 sentence before entering, don't take it. And if you can't review it in 1 minute after exiting, you didn't learn from it. Journaling isn't extra work. It's the work that multiplies every other effort. Your action step. And this one's non-negotiable if you're serious. For the next 7 days, log every single trade. Include time, setup type, emotional state before entry on a scale of 1 to 5, planned reward to risk, actual reward to risk, and 1 sentence on what you learned. After 7 days, scan your notes, find the pattern, then comment below with 1 word that describes what you discovered about yourself. Just 1 word: impatient, greedy, fearful, disciplined, because that 1 word is your starting point for evolution. In time, your trading journal evolves into your personal data set. It reveals your edge map, the 20% of conditions that yield 80% of results. You'll find your profitable time windows, your best setups, your worst triggers. You'll see how your emotional stability correlates directly with performance. And then, something magical happens. Improvement stops being random. It becomes systematic. But collecting data means nothing unless you act on it. The next evolution is transforming those insights into a living system that adapts over time, a self-improving loop that refines your edge continuously. Because trading mastery doesn't come from one big revelation. It comes from thousands of tiny iterations, measured, deliberate, relentless. And that's where the philosophy of Kaizen enters your world. Every trader dreams of a breakthrough, the one new strategy, the one perfect indicator, the one secret formula that will change everything overnight. But professionals know the truth. Breakthroughs are born from boredom, from small, consistent, deliberate improvements that look meaningless in isolation, but transform everything over time. That's the essence of Kaizen, the Japanese philosophy of continuous improvement. In trading, Kaizen isn't about revolution. It's about refinement. After 2 decades in the markets, I can tell you with absolute certainty, the traders who survive longest aren't the ones who reinvent themselves every quarter. They're the ones who tune. Tiny adjustments, incremental upgrades. They understand that a 1% edge improvement, compounded across hundreds of trades, becomes exponential performance. There was a period when my system flatlined. No growth, no disaster, just mediocrity. I was tempted to scrap it all and start from zero. But something inside whispered, change one thing, not 10. So I did. I widened my stop-loss buffer by just 0.3 ATR, a microscopic shift. The next month, my trades stopped getting shaken out by random noise. My win rate rose from 47% to 54%, and my expectancy jumped by nearly 40%. That one tweak was invisible in the short term, but over the next year, it made all the difference. That's Kaizen, improvement by millimeters that accumulates into miles. Intensity gets headlines. Consistency builds fortunes. They treat their strategy like a living organism. Adapt, measure, refine. The framework: identify, isolate, iterate, integrate. Identify what's underperforming. Look at your journal. Find the variable that hurts expectancy most, maybe stop placement, trade timing, or profit taking. Isolate that one variable. Don't touch anything else. Keep all other factors constant. Iterate over 50 to 100 trades. Gather enough data to know whether the change truly improved the system or just flattered it by luck. Integrate if the results are consistent. Then, and only then, move to the next small change. This process requires humility. It's not exciting. There's no adrenaline. But that's precisely why it works. It's hard to stay patient in a culture obsessed with speed. But the market punishes those who rush and rewards those who refine. But Kaizen isn't just technical. It's psychological. It's learning to improve yourself one emotional response at a time. For example, if you realize you panic after seeing red numbers, practice watching your unrealized loss for 5 extra seconds before reacting. That's micro-emotional conditioning. Or if you tend to skip journaling after bad trades, force yourself to write just one line. These tiny disciplines compound into unshakable consistency. The magic of Kaizen is that it removes perfectionism from the equation. You don't need to overhaul your life, you just need to be 1% better today than yesterday. Over 250 trading days. That's a transformation so large it feels like magic. But it's not magic. It's math, multiplied by time. Your next move, for the next 30 days, change one variable. Just one. Maybe it's widening stops. Maybe it's adjusting your session. Maybe it's adding a pre-trade breathing ritual. Measure it ruthlessly. If it improves your expectancy, keep it. If not, discard it. No emotion, no ego, just iteration. That's how professionals evolve without breaking their systems. That's how you build a machine that adapts faster than the market. But no matter how refined your process becomes, there will come a day when it all breaks, when volatility spikes, when patterns collapse, when your rules are stress-tested by chaos itself. That's when you'll discover the true strength of your preparation in your crisis protocol, the rulebook that saves your career on the worst day imaginable. And that day is coming. Section 10, Crisis Protocol. How to survive. the day that breaks everyone else. There's a saying on Wall Street: everybody looks like a genius in a bull market, but markets don't test your intelligence. They test your ability to stay alive when everything burns. And one day, it will burn. The charts will melt, spreads will widen, your stops will slip, and the calm discipline you've built will feel like it's evaporating in real time. That day is coming, and whether you walk away intact or destroyed depends on one thing: your crisis protocol. When panic hits, amateurs pray, professionals execute. Lehman Brothers collapsed. Within an hour, I was down 10%. My brain screamed, "Hold." My rules whispered, "Cut." I pressed sell. By noon, those stocks were down another 40%. Small loss saved my career. The lesson was brutal but clear. A small loss is tuition. A big loss is extinction. Your crisis protocol exists to stop extinction. It's not there to make you feel good. It's there to keep you breathing. Every professional trader has one. It's written down, rehearsed, and ready. Because when chaos comes, there's no time to think. Thinking is too slow. You need instinct that's been automated through repetition. Step 1, the 3-strike rule. 3 consecutive losses, step away. Not because you're cursed, but because you're emotional. The first loss hurts your wallet, the second hurts your ego, and the third hurts your judgment. After that, your brain stops trading probability and starts trading revenge. Step back, cool down. Step 2, hard daily drawdown limit. Every fund has one, but retail traders rarely enforce it. Mine's simple: hit -3% in a day, screens off, positions flat. Discipline is measured by the trades you don't take after losing. Step 3, circuit breaker ritual. I physically step away from the desk. 10 minutes outside, breathe, no charts, no phones. The market doesn't need me. It never did. But I need my mind clear if I want to come back. Step 4, debrief. That night, I write a single question in my journal. Did I follow my protocol, or did I follow my panic? No blame, just awareness. The reason these steps matter is simple. When volatility spikes, your cognitive function collapses. Neuroscience proves it. Cortisol floods your system, narrowing your focus to survival. Logic vanishes. You're no longer a strategist. You're an animal in a storm. And animals don't trade well. That's why systems save lives. Your crisis protocol is your oxygen mask. You design it in peace so it can save you in war. It's not about bravery, it's about survival. You can't ride the next bull market if you're bankrupt from the last crash. So, build your protocol. Write it, print it, tape it beside your screen. Make it a reflex, not a concept. Because the market doesn't warn you before the next earthquake, it just shakes. And when the shaking stops, when the dust settles, there's something even more powerful waiting on the other side. A way to turn your discipline into culture. To make survival not just a response, but an identity. Because after crisis comes rebirth, and that's where everything we've learned crystallizes into who you become. Section 11, Operator Culture, from discipline to freedom. At first, discipline feels like a prison. You're fighting impulses, suppressing greed, forcing yourself to do the boring things. Cut losses, wait for setups, journal your emotions. But one day, something shifts. The rules stop feeling like chains and start feeling like freedom. You no longer force discipline, you become it. That's when trading stops being a struggle and starts being an art. This is the birth of culture, your personal code of conduct. It's not written on your wall, it's written in your nervous system. Every small loss you take without hesitation, every big win you let breathe without fear, every rule you follow without negotiation, that's identity being forged in silence. A senior trader at the fund, Victor, had immaculate performance, not because he won more, but because he bled smarter. His secret? I stopped trying to be right. I started trying to be consistent. He graded himself on one thing: process adherence. Hit 90%, increase size. Miss it, stay flat. His account didn't grow fast. It grew inevitably. That's the essence of culture, results as a byproduct, not an obsession. The amateur celebrates outcome. The professional celebrates obedience. The amateur says, I made money today. The professional says, I traded well today. One is temporary luck. The other is permanent evolution. Building this culture means turning every rule into a ritual. You start each day the same way, not out of superstition, but to train your brain to enter performance mode. You end each week with a review, not to punish yourself, but to calibrate your edge. You treat your trading desk like a cockpit, not a casino table. You measure progress in process, not profits. Every great fund in the world runs on culture. They have codes of conduct, risk teams, performance rituals. But at the individual level, your culture is your risk team. It's the invisible layer between you and disaster. When you've repeated a rule enough times, it embeds itself into instinct. You don't think cut loss. You just click. You don't think let it run. You just breathe. This is why I tell my students, your goal isn't to follow the rules. It's to become someone who doesn't know how to break them. That's the metamorphosis every trader must undergo. Discipline stops being a performance. It becomes your personality. And the irony? Once it's part of who you are, trading gets quieter. The fear fades. The noise slows down. You start to see patterns others can't because you're not busy fighting yourself anymore. You've made peace with loss, and that peace turns into power. It's not about being emotionless. It's about emotional fluency, feeling the fear, but not obeying it. Feeling the greed, but not feeding it. You no longer trade for validation. You trade for mastery. Small loss, big win. Say it until it becomes your pulse. Because that rhythm, controlled loss, patient gain, is the heartbeat of every enduring trader. It's not glamorous, it's not exciting, but it's what separates the survivors from the stories. And once that culture is alive in you, there's only one evolution left. To rise from being a disciplined trader to becoming an operator, the CEO of your own financial machine, where every trade is a business decision and every number tells a story of efficiency, scalability, and freedom. This is the final transformation. Section 12, the operator's blueprint, becoming the CEO of your own machine. There comes a moment when you stop calling yourself a trader, not because you quit, but because you've evolved. You no longer gamble with emotions. You operate with precision. You don't chase setups, you manage systems. You don't trade charts, you run a business. This is the operator's mindset, where every decision, every rule, every dollar moves with purpose. You are no longer inside the market storm. You're above it, steering your own ship through it. Imagine your trading account as a company. You are the CEO, the head of risk, the strategist, the accountant, and the psychologist, all in one. Every trade is an investment decision. Every loss is an operating expense. Every profit is revenue. The amateurs treat trading like a lottery. Professionals treat it like logistics. They know exactly what percentage of capital is risked, what the expected return per trade is, and what their performance metrics look like over time. The operator's blueprint begins with structure, a one-page business plan for your trading life. At the top, capital rules. Never risk more than 2% per trade, 5% per week. Capital is the company's lifeblood. Protect it first. Grow it second. Next, edge definition. You write down what your system actually is, your top 20% setups, your filters, your invalidations. If it's not in the plan, it's not a trade. Then comes process cadence. You divide your operation into cycles: daily execution, weekly reflection, monthly iteration. Each day begins with a pre-market briefing, a checklist that calibrates your focus and emotional state. Each evening ends with a debrief, a short, honest review of your process adherence. Each week, you run a performance audit, win rate, expectancy, rule breaks, and every month, you perform a strategic review, find what's working, prune what isn't, and refine one element using the Kaizen method. Now you add metrics. This is where your system becomes measurable. Your key indicators aren't how much you made this week. They're your expectancy, your actual versus planned reward to risk ratio, your rule adherence percentage, and your profit and loss per trading window. You track your data like a hedge fund tracks investor returns. And you use those metrics to guide decisions, not your emotions. Finally, you establish accountability. Every operator needs oversight, even if it's self-imposed. Maybe it's a trading buddy who audits your journal. Maybe it's a performance coach who challenges your blind spots. Or maybe it's just a quarterly self-interview where you play both CEO and employee. If I worked for me, would I get a raise or a warning? This blueprint transforms trading from a series of emotional bets into a scalable enterprise. You start thinking in quarters, not days. You stop reacting to randomness and start engineering consistency. You realize that the market is just a mirror. It reflects the quality of your internal systems. When you operate like this, you stop fearing losses. They're just expenses that buy data. You stop worshiping big wins. They're just profits that fund evolution. Your mind becomes quiet, steady, and analytical. And from that stillness emerges the rarest commodity on Wall Street, clarity. A trader reacts, an operator designs. That's your final transformation from reacting to designing, from chasing to orchestrating. You no longer see trading as a battlefield, but as an ecosystem you control. Every variable, risk, reward, time, emotion, becomes part of your architecture. You are no longer surviving the market. You are running it like a business that prints probability into profit. And now, as this journey comes full circle, remember the paradox that started it all. You don't have to be right often, only disciplined enough to survive until your big wins arrive. That's the operator's law. The math never lies, and neither does time. Because once you master this blueprint, trading stops being about freedom. It becomes freedom. Now, there's only one thing left to do: build your machine. Turn this knowledge into operation. Draft your one-page operator blueprint. Write down your risk rules, your setup filters, your emotional rituals, your review cadence. Build dashboards that show you the truth, your expectancy, your rule adherence rate, your peak trading window, your best instruments. Make your system so clear that emotion has nowhere to hide. And when you've built it, run it. Not for a day, not for a week, but for 90 days straight. 90 days of unwavering discipline. 90 days where you act like a CEO, not a player. 90 days where every click has context, every loss has a lesson, and every win has humility. Your specific challenge: for the next 30 days, track one metric obsessively. Your actual reward to risk ratio versus your planned ratio. Every single trade, no exceptions. At the end of 30 days, calculate your average. Then come back to this video and comment with this exact format. Day 30, planned R to R, your number. Actual R to R, your number. Gap, your number. That gap, that's where your next evolution lives. If your gap is wide, you're sabotaging yourself emotionally. If it's narrow, you're operating like a pro. Either way, you'll know the truth. And if you found yourself nodding at the part about trailing stops or consensus zones or crisis protocols, there's a deeper layer we need to explore together. Next week, I'm releasing a video on the psychology of drawdown, how to maintain belief when your system is being tested, when every rule you follow seems to fail, when doubt creeps in like fog. That's where most traders break, but not you, because you're building something different now. Subscribe if you haven't already, not for more content, but for a commitment to your evolution. Every video on this channel is designed to make you think differently, not just trade differently. And as you sit there reading these final words, take a breath. Feel the weight of everything you've learned. You're not the same trader who started this journey. You've seen behind the illusion, the false gods of win rate, the cult of certainty, the lie of perfection. You now understand that control doesn't come from the market. It comes from your response to it. So remember this, the line that every veteran carries like a prayer. The market doesn't pay you to be right. It pays you to be disciplined. Trade like a survivor. Think like an operator. Live like someone who's already won, because in the long game, that mindset is your greatest position. I'll see you in the next one.